Welcome to our webcast. This short video interview offers you this chance to get acquainted with one of NNIP's investment professionals. Jeroen, welcome.
Thanks.
Before this taping, you mentioned something about the 08-09 crisis not only being negative, but also having two benefits for high yield. We'll touch upon that later. But first, tell me about the high yield performance of the past quarter.
Well, the second quarter hasn't been the best quarter for European high yield. We had a small negative return. This was mainly due to two events which played out through the quarter. And the first one was a significant rise in the bond yields we have seen during the months of May and June. And the second and most important one was the scenario in Greece, with Greece almost leaving the European Union, which came very close at the end of June. And especially the negative performance in June put the total return for the second quarter into the negative.
Yeah, that sounds like a small glitch in the road. What does that mean for future performance?
Well, if you look at the end of June, beginning of July, Greece and Europe came to a solution which led to a sort of a risk-on environment. So almost all what we lost in June, we made up in the first 2 weeks of July. But when you ask what do you expect for European high yield, we always try to look 12 months forward. And for the coming 12 months, we would expect a return of around 5 to 6%. This is based on a low default rate of around 1.5%. The current income you're getting on high yield, which is high 4%. And then some spread tightening and limited changes in bond yields, as I think we've seen enough of that so far.
I hear some solid mid-single-digit returns. That's good. But do you expect defaults to remain low and maybe spreads to tighten?
Well, as you mentioned that with your initial remarks, 2008, 2009 had some positive benefits for European high yield, and that's mainly through the behavior of senior management. The CFOs and CEOs of companies have become much more conservative in running their balance sheet. By that I mean they put more cash on it, they've termed out as much debt as they could, and in the last 4 or 5 years the only thing they've done is focus on taking their debt down. Which is beneficial for the current status of most companies. On top of that, we haven't really seen a very, very strong recovery in Europe, which meant that we haven't seen that many aggressive high yield deals like the 2006 LBOs, 2006, 2007 LBOs you saw. Therefore, the plans for the next default cycle have not been seeded yet.
So if I understand correctly, European high yield should be incorporated in investors' portfolios.
For the coming 12 months, yes, we think so.
Jeroen, thank you. And if you would like to find out more about this strategy, visit us at nnip.com.